chapter 17, accounting, valuation of inventory. When we talk about valuation of inventory, we're simply talking about how inventory are being valued in terms of the amount we place on them and how we get to know their final figure. So mostly at the end of it all, we need to know the value of our closing inventory. That is the point. So what do we have left? That is what inventory valuation is about. So we have different valuation methods. So we're going to start with the net realizable value, NRV. For NRV, it simply talks about you finding the value for the selling price and taking it away from the additional cost you might incur. So NRV is selling price minus additional cost. So that's about NRV. So we'll go to the activity 1 immediately. It said, Tavish makes and sells wooden furniture. He has just checked his inventory of finished furniture for the year ended 31 December 2017 and supplied the following information. His closing inventory was valued at 62,000. That's the closing inventory, 62,530. Remember, the closing inventory is still going to be part of your statement of financial position as current assets. Based on fiscal inventory count, all inventory was correctly valued at cost. However, Tavish discovered that some of the inventory was not a sellable condition. It means they are damaged. They can't sell them at that point. Yeah. So that means you have to work on them. So, tables with a sales value of 28,800 had been damaged in storage. These were recorded at 17,550. Now the record is now 17,550, and Tavish estimated that after repairs they could be sold for 20,800. So the repair cost will be 3,500. So that's an additional cost.
Yes.
So first, we have our closing inventory to be 62,530. Then we calculate for the damaged inventory, the valuation for the damaged inventory. The value is the lower cost of the NRV. We have the value, that's the selling price, which is 20,800. It's sold for 20,800 minus the cost of repairing the damaged goods to be 3,540. You take it away. That gives us 17,260. Okay. So now, what is inventory as at the end of 31st December 2017? The value you have, 62,530 plus 17,270 for the damaged one. Now you can sell them, it's sellable. Then you less it from the record of the cost. You have a record for it before, 17,550, that is your record.
Yeah.
But now that you are able to repair it, you are able to repair it. So now you sell it for 20,800, but you have to take away your cost,
which would be 3,500.
So now it will be 62,530. The value for your closing inventory will be 62,530 with your sales now, which is 17,260 minus the value you already recorded. So that gives you your value of inventory. So that is the valuation.
Okay.
So here we have 62,000. That's the closing inventory plus inventory value minus the estimated cost of the damage. So that gives us 62,240. Clear? That's activity 1. Right here. FIFO. Okay. So we go to first in, first out, last in, first out. We call it FIFO, LIFO. For FIFO, it occurs where inventory is issued to production or sales at the earliest price. The earliest, that means the latest price. The price at when we are producing it. Okay. That is FIFO. First in, first out. The price as soon as we produce or as soon as we want to sell.
Okay.
Then to calculate FIFO, it is cost of oldest inventory multiplied by the cost of annual inventory sold. Cost of the oldest inventory multiplied by the cost of annual inventory sold. Okay. That's how we calculate FIFO. And for LIFO, last in, first out. This occurs where inventory is issued to production or sales at the most recent price. That is the latest.
Yeah.
The earliest is the previous.
Yeah.
The latest is now. So we use LIFO for selling now. We use FIFO for the price of before now.
Yes.
So that's the difference between FIFO and LIFO. So for LIFO, it is cost of most recent inventory multiplied by the amount of inventory stored. For LIFO, it is cost of the recent one. For FIFO, it's the cost of the earliest price. Both are going to be on the amount sold.
Okay.
Clear? Is it clear?
Yeah.
So we have the method now. We have activity 1, right?
Yes. Two.
Oh, sorry, activity 2, thank you. So they said Sahan SAN manufactures components for bicycles. It provides the following information. It buys 200 units of products ZZ at 1.2 each in April 2009. SAN buys a further 400 units in September 2009 at 1.5 each. During the manufacturing process, 300 units of ZZ are issued in October 2009. Using the different methods for the pricing of inventory, show the cost of issues to production. Different pricing strategy used there, and the cost is LIFO and FIFO.
Yeah.
So here, for FIFO, they said we bought 400. SAN buys 200 units of products at 1.2 each in April. So 200 units at 1.2, that gives us a certain figure.
Okay.
But there's an additional, I did it here. So based on FIFO calculation, we say FIFO is cost of the oldest multiplied by the cost of the amount of inventory sold.
Okay.
So cost of the oldest is 200. That cost of the oldest is 1.5.
Yeah.
Amount sold is 200. That is 300 units.
Okay.
Yes or no?
Yeah.
So they said there's additional 400 units in September. Still first in.
Yeah.
Because the last in is October. The first in is September.
Right.
So first in, first out. 400 units. So here we have 400 units. 400 units was produced in September again. But we have to take it away from the first 300 produced.
Oh, okay.
Do you get the point here?
Yeah.
So 400 units minus 300 units give us 100 units.
units.
So our first in, first out will be 300 units.
Okay.
So it means 200 units at 1.2 plus
100.
100 units at 1.5.
Okay.
So that gives us 390. That is FIFO. Then for LIFO, because we only have last in, first out. The last in was 300 units and at 1.5.
Yeah.
1.5. So it's last in, first out. 300 units multiplied by 300 units multiplied by 1.5.
Yeah.
So that gives us 450. So FIFO is 390, LIFO is 450, and this is the working.
Yeah, using different methods.
Yes, we're going to be using different methods. Using different methods, I wrote the method chosen by the business must be continuously used. This is the principle of consistency. So just like depreciation, when you use straight line method, continue to use straight line method. When you use diminishing, when you use reducing balancing method, continue to use reducing balancing method. And when you are using valuation of asset method, continue to use valuation of asset method. We call it consistency principle. However, if the product is perishable, that means product that can easily spoil, you can use FIFO. First in, first out, because you have to sell those products as soon as possible. But if the products are products that can last longer, you can use last in, first out.
Yes.
Do you understand? So that is the point about this. That is using the different methods.
Yeah.
You use FIFO mostly for perishable goods. You use LIFO for mostly non-perishable goods. Clear? We'll move on. Periodic or perpetual inventory valuation. We call it periodic because we calculate our inventory for each transaction.
Yes.
For perpetual, we wait till the end of the accounting year. So here I wrote perpetual inventory, the calculation of inventory value after each transaction.
Yeah.
Then periodic, the calculation of inventory value at the end of accounting transaction or period. Clear? Is it clear, please?
Yeah.
We move on to
Inventory
valuation and the effect on profits
and assets.
and assets. When we use FIFO, will result in lowest cost of sales and a higher gross profit and a higher value of net assets. So what do I mean here? Because it is first in, first out. So whatever value we have, it's only look at the first transaction we did. We sold 400 units, but we are only able to record 100 units.
Yeah.
So that means our sales are going to be at the lowest. Because if we had recorded all the 400 units, we would have sold more than 390 that we sold.
Okay.
So, but what it means is that at that point in time, our gross profit will be higher because we still have goods that we have not calculated.
Yes.
But for FIFO, when you use FIFO, your sales value would reduce.
Yes.
Because you cannot calculate all the units produced. You have to calculate the first in and the first out. Do you get the point here? Good. However, if prices are falling, then FIFO would record a lower gross profit. But if the price is not increasing, if the price is falling, it simply means your gross profit would also fall.
Okay.
Because your gross profit is part of your cost, or your gross profit is part of your cost of sales from your sales.
Sales, yeah.
So if sales is falling, if the price of goods are falling, then your cost of sales, your sales would fall.
Yes.
And it will affect, when you are taking your cost of sales from it, you will be having a lower gross profit.
Yes.
Because gross profit is sales minus cost of sales.
Okay.
Clear?
Yeah.
But with LIFO, inventory evaluation is based on the oldest purchase. It sometimes results in lower profit. For LIFO, because we are selling at the oldest purchase, we are selling the last
Purchase.
first.
Okay.
So the last purchase, the value may be higher than the first purchase.
Okay.
So which means the last value, which is higher, will make our profits to be lower.
So
I will explain it again to you.
Okay.
For last in, first out. The last in is the last purchase and is the first to be sold.
So
but remember that you have a specific selling price that customers are used to. Now, if the price has increased, you won't be able to increase the price immediately.
Yes.
You have to sell at the price that you are used to selling.
And then.
And you have incurred more cost
Okay.
for the last purchase. But the last purchase that you have incurred more cost is the first that is going out.
So like you got more cost. Like
You
the first
incur
getting
more
out.
cost.
Okay.
You incur more cost in the last purchase. But you have to sell at the same price, at the recent price.
It's a price, yeah.
Last in, first out is the last purchase at the recent price. Do you get it? So your last purchase you have incurred more cost in your last purchase, but you are selling at the recent price.
Yes.
So your profit is lesser. Is it clear? Good. So we go on to activity 3. Thank you. So they said Nat purchased 60 boxes of towels in February 2019 for 22 per box. He also buys an additional 30 boxes in April 2019 at 26 per box. In July 2019, he sells 80 boxes for 68 per box. You are told that the closing inventory at 31 December 2019 must be valued for use in the trading account of the business. Calculate the value using FIFO and LIFO. So we have activity 2 for NAT. So we are told to calculate activity 3 for NAT. We are supposed to calculate for FIFO and LIFO. So for FIFO, we talk about the goods in. For February 2019, we have the boxes, excuse me, the quantity is 60 and the unit price is 22. 60 and 22. Do you get that? For April, goods in are 30, the boxes in are 30, and the value for the box is 26. That is goods in for NAT. Clear? Then we go to the goods out. July. He said in July 2019, he sells 80 boxes. 80 boxes were out in July. Yeah, so the balance as at 31st of December 2019 is the total of goods in minus the total of goods out. Goods in 90, total of goods out 80. So we have 10 units as at December 31st, 2019. Are you with me?
Goods in.
Goods in. The difference now, the total goods, the balance of inventory now.
Yes.
Goods in were 60 for 22.
Because he purchased it.
Then additional 30 for 26. So the total goods in were 90.
Yes. Total purchase.
Yeah. So goods out. In July 2019, he sells 80 boxes. Goods out is 80.
Yeah.
So the value of inventory we have now is goods in minus goods out.
Yes.
Which is 90 minus 80, which is 10 units of goods left.
10 units.
So our FIFO will be, remember FIFO is first in, first out.
Yes.
So the first in was the price 10, and the quantity out, the first in is the price of 26, and the last in was at the price of 22.
Yes.
Do you get what I'm saying? No.
Goods in is 90 at the price of.
The first in
Yes.
was the price of 26.
Yes.
The last in was the price of 22.
Mr. First in is 22. And then last in is 26.
First in, first out. Last in, first out.
Oh, okay.
We use FIFO. When we are calculating FIFO, you use the last price.
Last price, okay.
For LIFO, the recent price.
Okay.
So FIFO here is the value of goods left, 10, multiplied by the first in, first out,
Yeah.
which is 26.
Mm-hmm. 26.
26 here.
Okay.
For LIFO, last in,
Last out.
last in, first out.
First out.
The last in, the quantity last in is 30.
Mm-hmm.
The price first out is 22.
22. Okay.
So first in, first out is 10 multiplied by 26. Last in, first out is 10 multiplied by 22.
Mm-hmm.
That is where the twist is.
Yes.
The unit price for the first product is 22.
22 per box.
The unit price for the last product is 26.
Yeah.
Get. But remember, when we are calculating
FIFO.
FIFO,
FIFO is first out.
first in,
First in and
first
first
out.
out. Okay.
For LIFO is last in, first out.
Okay.
Last in of output is 30.
Mm-hmm.
The first price is 22.
Yes.
First in is 60.
Mm-hmm.
The first out is 26.
26. Okay.
10 multiplied by 26, 10 multiplied by 22. First in, first out is 26. Last in, first out is 22. 260 for FIFO, 220 for LIFO.
LIFO.
We go to activity 4. Yeah. It's a long one. I only did a FIFO. Anyway. There's a music camp, right? Music camp, Music Man and Co. purchased one model of guitar. The cost of these guitars during the year ending 30 June 2017 varied, but the company sold all the guitars at 57 fixed price of 800 each. Inventory was taken on 30 June 2016 and this added up to 33 units at a total cost of 6,600.
Okay.
The following details are for the guitars purchased during the year. So we have goods in, then goods out. So our table is going to contain the inventory in, the unit price, the inventory out, the quantity, the units, and the value. So for 3rd of July, we have 120. 120 was produced, but they said it started with 33 units.
Yes.
So the quantity at the beginning was 33, and the unit cost. The unit cost is 200. So we have 33, the unit is 200, and that gives us 6,600. It's said there. We have 6,600, which is the total cost. So on July 3, we have 120. 120, the value is 270. The unit of guitars purchased in July 3, 2016 is 120. The price is 270. So 120 multiplied by 270 gives us 32,400. You add it with the value of the guitars we have in 30th of June. That gives us 39,000.
39,000.
39. Yeah. So the value is 39,000 now. Sales in July, August. You go down, July, August, we have 30. Which is for 3.
July
the quantity
and August is, so its purchase is 120. So which is
the unit is 200 multiplied by 3. 3 multiplied by 200, that's 600. You add it up. That's 600 for the sales in July is sitting here. Sales July, quantity sold is 30.
Okay, so it's 30, yeah.
And we already have 33, it's adding up to 33. So that reduces it to 3. That makes us 30. Did you get it or not? We have 30 sold. How many is left? 3.
3, yeah.
3 multiplied by the 200 gives us the 600. Done. Then, the unit in July is 120. 120 multiplied by 270 gives us the 2,400. Okay. So, the 2,400 plus 600 gives us 33,000.
Yes.
So, the value for July and August is 33,000. Let me explain again. We have the value for inventory at 6,600.
Yeah.
In July, we have 120 inventory. The unit price is 270. You add it together. You add it. That's the value for July. Now, July/August. The inventory out is 30 out of 33. The inventory left is 3. Do you get it or not?
Yes.
3 multiplied by the unit cost, which is 200, is 600. So 600 with the total in July gives us this amount.
Okay.
Now go to 6th of September. We have 100, 300 units, 100, 300 units. 300 times 100, that's 30,000. 30,000 plus the value of July, August, 63,000.
Okay.
Now, what is the value for September sales? September, October, 90.
Yes.
The total added up is 33 units again. 33 multiplied by 90, 270. 270, 33 multiplied by 270, sorry. 8,900 because the total unit price is 270.
Yeah.
So 270 multiplied by 33 is 8,019. That is for September, October. Now, the value is for September/October, which is 90, is done. Then the value left is 100.
Yeah.
100 multiplied by 300 is 30,000. This. We take it back here. First in, first out. So 100 multiplied by 300 is 30,000. 30,000 plus, not here, this is the value for September, you stop here. So for September, October value, 8,910 plus 30,000, 38,910. You add them. That is about September value. So the value for September, October is done. Now go to October, November. For 20th of November, we have 180 guitars for 330 units. So 180 multiplied by 330, that's 59,400. You add it up with the value for September, October.
Yes.
That's 59,400. Clear?
Yeah.
Done. 59,400 plus 38,910 gives us 98,310. Done.
Yeah.
We go to November, December. November, December value, we have 150 for 163 because it is 180. Take away 33, 163.
Yeah.
So we have 163 multiplied by 150. 163 multiplied by 330 gives us this value. We put it down. That's the value for November, December.
Yes.
Now, after November, December, we have March, 25th of March. We have 240 for 390. 240 for 390. 240 multiplied by 390, 93,600. 93,600 is the value of inventory. You add it with the November inventory, closing inventory for November. It gives us 147,390. January, March sales, 210. 210, take it away from here, we have 193. 193 and 390, which is the value of inventory for the price for 25th of March 2017. 390 multiplied by 193 gives us 75,270. The inventory are reducing. It gives us 75,270. In 2nd of May 2017, which is the last one, 120 inventory for 120 purchases of guitar for 420 per price. So 420 multiplied by 120, it gives us 50,400. You add it because that's the last inventory we have. You add it with the closing inventory on March. In March, it gives us 125,670. Now the value for April is 60. 60 minus 193, 133. You know, you are taking the inventories, you are reducing them. 60 minus 193, we have 133. 133 minus 133 plus multiplied by 390, 51,870. 51,870, 51,870, that's the value. Then the value for April, June, for May 2017 is 120, because after April it is May. 120 multiplied by 420, that's 50,400. That's what you add to the April, June inventory, which is 102,270. So the FIFO is 102,270. I didn't do it. For LIFO, you take it away. Instead of taking away the inventory, you add each inventory. Okay. So listen, for in LIFO, instead of having one here, taking it away, 123, no, you add. Each quantity, you add each quantity. Okay. The last thing with the first out. The last thing with the first out. Okay. You don't deduct, you add. You add for LIFO, you deduct for FIFO. LIFO. So that ends valuation of inventory chapter 17.